We're going to start off with basic definition, what is a U.S. person, then move on talking about outbound compliance. Outbound compliance is with respect to a U.S. person doing business abroad. Then we move to inbound compliance, a foreign person doing business in the U.S. Here it comes down to a basic question, what is a person? In part one, we're going to define what is a U.S. person and what is a foreign person. When I see the term of person, it doesn't necessarily mean we're talking about an individual. A U.S. person can be defined as a citizen, a resident, a partnership, corporation, state, or trust. A U.S. resident also includes lawful permanent resident, who is a green card holder, or anyone who passed the substantial presence test. You will be considered as a U.S. resident for tax purpose if you meet the substantial presence test for the calendar year. To meet the test, you must be physically present in U.S. on at least 31 days during the current year, and 133 days during the 3-year period that including current year and 2 years immediately before that, counting all the days you were present in the current year, and 1/3 of the days you were present last year, and 1/6 of days you were present in the second year before the current year. Whether if a U.S. partner is a U.S. person, it's not always easy to tell. It is determined by whether the partnership is governed by U.S. or foreign country law. A U.S. corporation is a company incorporated in one of the 50 states, not where it is managed. Many foreign countries use where the corporation is managed to determine the residence of the corporation. However, in the U.S., we do where it is incorporated. A U.S. estate has to be defined by U.S., not foreign definition, in order to be considered as a U.S. person. And now, what is a foreign person? A foreign person is everything else. Now we have the very basic out of the way. We're going to talk about outbound compliance. A certain U.S. citizen, resident, who is officer, director, or shareholder in certain foreign corporation, they have to file a form called 5471. 5471, for those you might not aware, it is more like to fill up another Canadian T2. Why 5471 has to be carefully completed? Because it is the first place where IRS looked by their international tax examiners when they start looking for issues such as subpart F and transfer pricing. Transfer pricing is the price related party charged to its goods and services, and subpart F is a mobile part of mobile type of income when you have a controlled foreign corporation. 5471 has various schedules needs to fill. Which schedules needs to fill is determined by which category you are currently in. Category 1 is currently under appeal, so we can ignore it. Category 2 is a U.S. officer or director who has 10% U.S. ownership in a foreign corporation. And category 3 is a U.S. person acquired 10% of ownership in a foreign corporation. And category 4 is a U.S. person who controls a foreign corporation for an uninterrupted 30 days during the year. And category 5 is a U.S. shareholder owns stock in a foreign corporation that is a CFC for an uninterrupted 30 days or more during the year, who also owns that stock at the very end of the year, on the last day of the year. IRS is getting tougher with failure to file 5471 in recent years. If you haven't filed, please come to see us first. We can certainly help you fill one up as soon as possible with a letter addressed to IRS to try to claim reasonable costs before IRS figured out you haven't filed. New section 6501C8 says the statute of limitation of any items of the return won't start to run if you haven't filed 5471. Next form I want everyone to be comfortable with is 8832. a so-called check-the-box form. 8832 allows you to choose how you want the foreign entity to be treated, either a flow-through or as a corporation. You can check the box to elect the type of entity you want it to be treated, except for those IRS referred as per se corporation. It must be an eligible entity to qualify to file 8832. When can you file the Form 8832? It has to be filed within 12 months before the effective date or 75 days after. You have to make sure that you don't screw up with this seemingly simple form to make sure you get the right impact you want, because if the deadline had passed, you might not have a chance to go back and end up stuck up with the type of entities you don't want. There are other type of foreign entities, such as foreign disregarded entities and foreign partnerships. Form 8858 is information return of U.S. person with respect to foreign disregarded entities. This form is an informational form. The IRS defines a disregarded entity as a business entity that is separate from its business owner, but which elect to be disregarded as separate entity for federal tax purposes. Certain U.S. persons that are required to file Form 8865 with respect to a controlled foreign partnership. Similar to 5471, there's 4 filing categories. Category 1 filer is a U.S. person who controlled foreign partnership at any time during partnership's tax year. And a Category 2 filer is a U.S. person who at any time during tax year owned a 10% or greater interest in the partnership, while the partnership was controlled by U.S. partners, each owning at least 10% interest. And a Category 3 filer is a U.S. person who contributed property to a foreign partnership in exchange for an interest in the partnership. And finally, Category 4 filer is a U.S. person who had a reportable event under Section 6046A during that person's tax year. Reportable events such as acquisition, disposition, changing in proportional interest in the partnership. Also want to mention here that Category 1 and 2 filer has annual filing obligation, and Category 3 and 4 filer are transactional filers. The penalty for late or fail to file 8858 and 8865 is the same as 5471. Now we move to foreign tax credit. FTC is one of the hardest audited tax areas by IRS besides transfer pricing. If you are an individual, you might get credit from flow-through entities through like S Corp, partnership, or LLC. You can claim foreign tax credit by filing Form 1116. If you are C corporation, you can file Form 1118 to claim foreign tax credit. The key to remember where the most people miss is the foreign tax credit rule is not the same as foreign sourcing rule. The sourcing rule is determined by Section 861 to 865 in the code. There are rules to determine the source of income under Internal Revenue Code. The characterization of item of income as foreign source income doesn't mean that income is subject to foreign country tax. Similarly, the characterization of U.S. source income does not mean the income is not subject to foreign country tax. You can have situation where you have income subject to foreign country tax, but you are not get credit because it's all U.S. source income under the sourcing rule. Some sourcing rules are pretty simple. For instance, for some athletes, the service income is sourced by where the service is performed. Another example is inventory. It is determined by where the title is passed. What's the proof of foreign tax paid? There are different rules for cash or accrued basis of taxpayer. The primary rule for cash basis taxpayer are either tax paid or withheld. For accrued basis taxpayer is the actual tax return filed. if IRS is satisfied in complete discretion. We now move to U.S. individual working abroad. Should a U.S. person doesn't have to pay U.S. tax of what they earn overseas, only if their making is under the exclusion threshold. Well, then they don't have to pay tax up to that amount. But they still have to file a form called 2555, taking the exclusion on the form. For tax year 2013, the exclusion is up to $97,600 for per qualified person. Who is eligible for the exclusion? You have to be either physically abroad for 330 days during 12 months or qualified as a bona fide resident of foreign country for the entire year. Our final outbound topic is FBAR. If you haven't heard about FBAR in recent years, you're probably already in trouble. This is the hottest issue This hard issue with IRS for the international perspective. Any U.S. person with a foreign bank account aggregating more than $10,000 US at any time during the year must file FBAR. It does not include an account with a U.S. branch of foreign bank or foreign branch of a U.S. bank. FBAR has to be timely e-filed, not with the return. It has no extension and need to be filed to the computing center of IRS, not the processing center where your return is filed. It must be received by June 30th. There are various penalties for failure to file FBAR. IRS can impose a civil penalty for $10,000 for each non-willful violation. The penalty is greater of $100,000 or 50% of the maximum balance of the account if you are found to be willful. Then it can go all the way to criminal penalty, including a fine of $250,000 and 5 years of jail time. Keep in mind the statute of limitation is 3 years. It's not 3 years, but 6 years in this case. Now it's time for us to talk about inbound compliance, foreign person doing business in the U.S. We often see scenarios such as a Canco engaging U.S. trade or business, or a Canco has 25% or more interest in a U.S. subsidiary. In either case, either the Canco or U.S. subsidiary has to file a form called 5472. 5472 is a lot simpler to complete compared to 5471. For the respect of 5472, the whole ballgame here is the IRS wants to go after transfer pricing. Their concern is that a U.S. subsidiary is paying too high price to its foreign parents. Once again, if you fail to file 5472, you're subject to annual penalty of $10,000. In addition, IRS might deny your deduction of cost of goods sold. Let's talk about foreign taxpayer with U.S. source income. We have two prime tax systems with respect to foreign person doing business in the U.S. Result in business income. They pay tax at graduated rate. For individual, they file Form 1040 NR. NR stands for non-resident. And if they are foreign corporation, they have to file 1120F. F stands for foreign corporation. What happens if they have income other than business income, such as FDAP, fixed, determinable, annual, and periodic non-business income, such as interest, dividend, royalty, etc. FDAP is required to be withheld at 30% withholding rate, with certain exceptions under the treaty. Here I also want to mention capital gain generated from selling of U.S. shares. The capital gain generated other than selling of U.S. real property interest are basically exempt from U.S. withholding tax. Now we go to trade and business income. They are actually two standards. One, you have someone coming from non-treaty country that fell into trade and or business standards, or someone from a treaty country, then PE standards kicks in. At any time, if you have a foreign person from a foreign country touch the U.S. in any way, you are in U.S. trade and business standards. On the other hand, if they are from treaty country, then they only subject to U.S. tax if they have a PE. What is a PE? PE is a place of business in U.S. or dependent agent with authority. In addition to regular tax, there's U.S. branch profit tax. Branch profit tax is designed to equate the tax treatment of branch and subsidiary operation by imposing a 30% tax equal to 30% of a foreign corporation's dividend equivalent amount. Dividend equivalent amount is sort of estimate how much money is going to send from U.S. subsidiary to its foreign parents, hypothetically. Only 1120F is subject to two layers of taxes, corporate income taxes and branch profit tax. Now we're going to talk about withholding tax on FDAP. Annual fixed, determinable, annual, and periodic income. What is going to get reported on? They are going to get reported on Form 1042. FDAP withholding imposed if income derived from source within U.S. Of course, there are exceptions. If you have U.S. source income that is effectively connected with U.S. trade or business, then there's no withholding. The withholding exemption for ECI generally does not apply to a foreign person's personal service income. However, treaty often reduce the withholding rate. Here are a few examples. Withholding is not required if dividends to a payee who has valid U.S. ITIN number, applied through issue Form W9. Most other FDAP income eligible for treaty-based withholding relief required to be reported on Form W8 ban. A non-resident alien who receive income from U.S. trade or business require filing Form W8 ECI. We often see examples such as Canadians who receive U.S. rental income from their U.S. vacation home. If that's the case, they do need to fill up the form called W8 ECI. The last example is non-resident alien employee or independent contractor who filed Form 2233 for U.S. compensation received eligible for treaty-based withholding relief. If you are a non-U.S. person wants to expand into U.S., there are a few vehicles you can choose. You can set up U.S. subsidiary, but you might facing double taxation, or someone might consider an S-Corp. But S-Corp is not option for non-resident alien, U.S. non-resident alien or foreign corporation. Another option is partnership or LLC. U.S. partnership or LLC can have non-U.S. partner. A U.S. partnership with U.S. owners is subject to withholding tax. What are the enrollment forms you have to fill up? The forms such as 8804, 8805, and 8813. Even the partnership is treated as flow-through entity, the partnership must withhold tax for its foreign owners of partnership.